As we move throughout 2022, we have a lot more information and a lot more data coming out from the top dogs in the industry. So in today's video, Benny and I are going to give you a nice detailed market update from some of the best analysts in the industry like CoreLogic, RP Data, like the Commonwealth Bank of Australia, SQM, and Property Share Market Economics. So let's get stuck into it.
I'm excited about this one today, man. Like, I don't know why I sort of get off on the market update.
Yeah, me too these days.
I love the data. It's kind of like my sanity check. The weird thing about this one is there's going to be a bit of negativity in it in terms of some of the predictions that we're coming forward with. Obviously, the media has still been really, got its hooks in at the moment. It's scaring people. A lot of big headlines out there. Many of them will come through, others won't. We don't know which ones will be which yet. But in today's video, I think kicking things off with some of the stuff that CBA is saying would be a good place to start. Yeah,
without a doubt. I did a lot of research earlier this morning, just jotted down a whole bunch of stuff here, guys, that we're going to take you through. So CBA's come out with their predictions indicating they believe the Australian property market from a peak to trough will decline around 15% in this current cycle. So, only time is really going to tell there, but that's a pretty decent decline for a lot of markets. Now, that's Australia-wide as well, so it will be felt differently throughout different markets around Australia. They actually believe that property prices will reach that floor by the middle of 2023 as well. So there's sort of a light at the end of the tunnel, and the next 12 months are probably going to be the worst of it. Then property prices are expected to begin to rise in the second half of 2023, which is, positive sentiment coming out there as well, knowing that, things are happening, but there's obviously some positive growth expected in the not too distant future as well. Now, they did go in to talk about the fact that they believe the majority of the declines will be felt in Sydney and Melbourne.
Which represents 70% of the market, right? So when you say 15% decline in Australia, 70% of the market is influenced by them. So when they're going up, Australia looks good. When they're going down, it looks bad.
Yep.
And this is what massively confuses investors, including myself, because it's all going bad until you realise there's just two markets at the moment. In CBA's words, it's a two-tier market. There's Sydney and Melbourne in a box that is getting a drag after 100% growth in 10 years. Then there's your Brisbanes, your Perths, your Adelaides, which are in an almost entirely different box since the last GFC. Outside of the very CBD and beaches of those markets, there's a lot of suburbs that haven't done much at all.
Exactly. It's all relative, and it depends on when you bought the properties as to how much it's really going to impact you. Now, they go into talk a little bit about what their expectations for the Reserve Bank of Australia are going to be. Now, as of today, we're recording this video basically at the very beginning of September, and the current cash rate sitting at 1.85%. Now, RBA and CBA believe that the rate will go up about another 75 basis points, and they're aiming to get the target cash rate to about 2.6% by the end of 2022. So this interest rate rising environment, not yet over, but not much further to go according to these guys. And basically the RBA is looking at inflation, wanting to curb that inflation, get it back to historic levels of 2 to 3%, which will take a few years to get back down there. But they're seeing some signs of positivity, which is hopefully enabling them to sit that cash rate at 2.6%. But we'll see what happens later this year.
From reading the Reserve Bank's notes plus CBA's weekly update at the moment, there's one of three things that will most likely happen. In America, increasing rates isn't having the effect on inflation that they were hoping it was going to have. So they are very, very, very aggressively going to increase the Reserve Bank, or the Fed will the Fed will increase their rate in America, and the Reserve Bank will do the same in Oz. So one scenario is that this doesn't work, inflation doesn't come within a normal range in Australia, and they keep cranking it up. That's a worst case scenario. A medium case scenario is it looks like it is working, spending is on the decline, at least in my household and many other households that I know.
Same.
And this fear in the media is really having a positive effect on scaring people into not spending their money again. And we hit a point where it stabilises, we hit the target rate, 2 to 3% inflation, they see it for a little while, And then the third scenario, which is what the Reserve Bank and CBA and every other major bank in Australia are predicting, is they get inflation under control and then they cut the shit out of that rate again and we end up with another property boom. But we'll talk about that in a couple of years when it washes through.
Let's see if it happens, hey? Now, I'd love to move on to CoreLogic. Some really cool stuff coming out from them as well. About 30 years of capital growth in Australia. I'll come to that in a second, but I want to talk about the current market where they are indicating that around Australia at the moment, the prestige markets are seeing the largest declines in Australia. And this generally happens, when you get big booms, these prestigious markets, these very expensive suburbs and areas to buy in, have really big booms and then really big busts as well. So that's sort of leading it and leading the charge with all of the declines there as well. They indicate that they see inflation peaking at just over 7% as well, which is a lot better than a lot of our Northern Hemisphere counterparts as well. So best thing about Australia, we do have a good government, we do have a good financial system, and we are a bit more proactive than reactive to some of the people that we follow. And the fact that the US and the UK are sort of 6 to 12 months in front of us gives us a little bit of, breathing space there as well. But it's good to know.
It's interesting that, man, because, if you think about it like the way that I do, since the end of the last GFC, let's call it 2011, we've had a decline there. Then we had the 2017-18 decline in Sydney and Melbourne when they made borrowing money really hard to do. And we went from 50-50 mums and dads and investors to 90% mums and dads and 10% investors. But they both went way down because it was fucking hard to borrow money.
Yeah.
And we saw prices in Sydney in those years come down around about 15% peak to trough and about 12% in Melbourne. And then as interest rates started to be cut, they went up again. Then we saw COVID, and there was a period of time in COVID for about 9 months where we were getting properties in Brisbane, and I heard people doing the same in Sydney and Melbourne, 15% below market, peak to trough. And now we're in our fourth time in 10 years where the government in Australia, and I love this, because our banks are so heavily indebted in property, we cannot let our system fail the way that they can in Europe and America because they are way more diversified, their banks over there. And so our government constantly intervenes and creates these mini corrections. And instead of getting this like monster 30 to 35% decline every 18 years as per the rest of the world, we get these sort of like constant mini tweaks which build confidence again, reset the market, and then people do their thing. But, we have no idea what the hell is going to happen. But some of this stuff you're about to go on, sort of like remembering the future through looking at the past. Yeah,
we'll get there in a short minute as well. I'm just holding that cherry there, but it's coming now. Obviously, there's been a huge issue in the construction sector. They have experienced some of the worst inflation here in Australia. And CoreLogic actually indicated that construction costs are up 20.3% over the last 12 months alone. So tough time to be building brand new places at the moment. This is not necessarily going to dramatically impact your everyday investor, but developers that are building big time projects, these are increased costs which are going to be passed on through to us one way or another.
Can I point to something on that? Like, the great thing about that inflation in that sector, and I look at construction as like there's residential, then there's commercial, industrial, then there's all of the infrastructure construction. If the average wage in those areas is, again, bottom to top ends up being 25%, there's going to be millions of Australians who are earning significantly more money, that are saving significantly more money, and that money will eventually find its way back into stocks, crypto, and property. So down the line impact of this is positive, but it has been brutal for these poor builders short term.
Short term, for sure. And, there's so many infrastructure projects, and with the rental crisis, the government needs to bring new supply to the market. So the construction industry is going to have a lot of work ahead of them, which is great to see. Now, the other thing that is being talked about a lot at the moment is rents. Rents are on the rise nationally. Vacancy rates, which I'll get into in the SQM side of things, are at extraordinary low levels at the moment. And this is allowing investors to increase their rental yields, their rental returns. Now, rents are up about 9.1% over the year in the capital city markets. Now, that is houses and units. Wait till I get into the information about just houses alone. Now, the capital city house rents have increased 15.1%.
So that's
over the
Sydney,
last 12
Melbourne,
months.
Brisbane, Brizzy, Hobart.
The big cities. So,
Man.
this is the thing, like when we have inflationary periods, when you have low vacancy rates, investors are smart and they're going to pass those fees on to a lot of other people. And it sucks that it just the buck gets passed to the lower socioeconomic demographics. It's, sort of a backward system, but it's what's happening at the moment.
Well, to put this into perspective, rents in Brisbane, many parts of Sydney and Melbourne, in real terms, when you factor in 2.5% inflation in the last 10 years, haven't actually increased for 10 years. Labour rates in the construction industry in Brisbane, Sydney went through a bit of a construction boom, so did Melbourne, and so rates did go up there about 3-4 years ago. But in Brisbane, I know trades that were earning the same money 12, 13 years ago that they were earning last year.
Yeah.
So it's not necessarily that like this inflation inflated rents, and it was just that Australian businesses have been fuckwits to their employees for ages and would, pretty much had stagnation in wages for 10 years and also rents. And it's now, we've finally gone through a period where like that can finally be passed on and people are earning a bit more on what they're worth and rents have gone up. And so unfortunately it's happened in 1 year versus like a constant climb, but it's sort of like both. It's like, it sucks that we're passing this on, but it's also like, it was well and truly ready for it to happen. Like, you can't have prices go up in Sydney by 100% and wages go up by 10% over 10 years and not have a catch up in wages and rents at some point.
Yeah, it's all relative, and that's why you can't just look at one of these things and make a decision based on that one thing, because there's so many other factors that come into painting the picture, right?
100%.
Now, looking at the percentage change over the quarter compared to the last 12 months in the major capital cities around Australia, there's a fair bit of diversity here. Looking at Sydney, it's down almost 6% over the quarter, but down only 2.3% over the year so far. Melbourne down 3.8% over the quarter, down 2% over the year. Brisbane only down 2.4% over the quarter, up basically 18% over the last year, so still sitting in a really positive place over the last year. Adelaide is up 1.7 over the quarter and up 21% over the year.
Wow.
So Adelaide's still looking pretty good at the moment. Perth sitting flat at the moment and up about 4.9% over the year. So very diverse, and I think it really shows that Sydney and Melbourne have so much influence on the rest of Australia because they are such big markets, because those numbers look quite good everywhere outside of Sydney and Melbourne.
Absolutely, man. Like, give me a year where I can make 20% once every decade and I'll be stoked.
Oh my God, man, seriously. And looking back, like, this is where I want to talk about the 30 years of capital growth. So from 1992 through to 2022, CoreLogic's looked at the performance of houses in capital cities, houses in regional markets, units in capital cities and units in regional markets. Now, regardless of where you spent your money over the last 30 years, everybody has made some amazing capital growth.
Yep.
And this is why you need to become a long-term investor, because there is some amazing returns, but there is much better returns in certain asset classes and markets than others. And if you want to get the best return on your investment, these numbers moving forward look awesome. So the houses in capital cities have increased by 453% over the last 30 years.
Which I think I worked out to be, when you look at that increase by 30 years, an average of 15% per annum in the capital cities, which is just monstrous. Insane. And that's why so many of these baby boomers have got so much coin.
Seriously.
They all just had to buy a couple of houses 30 years ago and it was all good.
Exactly. But then looking at units, units over the last 30 years in the combined capitals has increased 306%. So that's 147% below the houses. So that's a fair chunk of change to be left on the table by if you had bought a unit 30 years ago in one of the capitals versus a house in one of the capitals 30 years ago.
And that's why we have always thought buying houses is better, because we've seen this data from CoreLogic for 15, 25 years before this new data's come out. And this really just reinforces, if you're only going to make a small number of purchases in a lifetime, go for the property with the most potential, which is the one with the biggest land in the capital city.
Yeah, now a very common trend at the moment is a lot of people talking about the regional markets being the place to invest moving forward because of the change after COVID. Now, the numbers historically look completely different to that narrative. And I think, moving forward, the government's going to prioritise spending more money in those capital cities where the bigger populations are, where the higher income earners are located. And the numbers don't lie here. Over the last 30 years, houses in regional markets are up 313, or basically 314%. So about 140% lower than houses in capital cities over the long term. So in short periods of time, maybe you see some really positive growth in regional markets, and then you've got your outliers like a Noosa or a Byron Bay and things like that. But I'm looking at the averages, and based on these numbers, I'm always going to prioritise buying houses in capital cities moving forward.
I really just swing personally between like buying Brisbane when it's cheap, and then it will get expensive at some point, and then buying Sydney and Melbourne when they're cheap. And then, that's sort of like, I'll just be an East Coast investor because that's where 75% of the jobs, population, infrastructure is going to go. I think they said Sydney and Melbourne will be cities the size of 10 million people within 25, 30 years, and Brisbane will be the size of Sydney and Melbourne today in 22 years. So, I'll have fun in my life, and I'll just be consistent with my investing behaviour.
Yeah,
you know what I mean?
Exactly. But I do want to talk to units as well, because I think it'll help people make decisions moving forward. Units are up just 212% in the combined regional markets over the last 30 years. So, here, guys, the numbers clearly don't lie. If you want to get the best return on your investment, focusing on houses in the capital cities typically outperforms. Now, moving into some of the SQM results, we just only have the July 22 vacancies at this point in time. National average still sitting at just 1%. So this is just chronically undersupplied. Sydney sitting at 1.5%, Melbourne 1.6%, Brisbane 0.7%, Perth 0.6%, Adelaide 0.4%. Now, one of the important things to talk about is the actual the capital city house rents have increased 15.1% over the last 12 months because of these extraordinarily low vacancy rates. And now what's happening is the CBD vacancies are actually dropping as the international migration picks back up. So we're seeing declines in the inner city markets nowadays as well, which is going to put even more pressure.
Sydney and Melbourne were like 2.5% to 3.5% a year ago. Like, that's extraordinary to hear that, bro.
Yeah, exactly.
I had no idea. Like, a vacancy rate, just so everyone knows, below 2%, according to SQM, would be chronically undersupplied. Above 3% would feel like oversupplied, and you'd be waiting 4 to 5, 6 weeks to find a tenant. I had no idea that Sydney and Melbourne, like, that's a chronic undersupplied there too now, which I wasn't expecting for another 2 years. Yeah,
this rental crisis unfortunately isn't going away anytime quickly. Whilst the vacancies are starting to pick up, very small levels, and it's going to be challenging for a lot of tenants out there that are having to pay rents. I know on all of my properties, my property manager's constantly telling me to increase the rents at the moment, and it's just one of those realities of the current market. But, same thing goes as you were talking about before with wages. Like, rents in a lot of markets haven't done much over the previous, like from 2010, 2011 through to 2020, we weren't seeing much movement in the secondary cities like Brisbane, Perth, Adelaide, things like that. So, it was always going to be passed on at some point in time. It's happening right now.
It's happening now.
Now, the other thing that we want to talk about was some of the stuff that we've been seeing from Phil Anderson, Ackle Paddle, Darren Wilson, Catherine Cashmore, the Cycles Trends Forecast and the Property Share Market Economics team. These guys are looking at more of an Australian level. They're looking at more of a global level, so it's less individual markets. But I think one of the coolest things to talk about is just the confidence coming out from Phil and Ackle and Fred Harrison, that they do believe the cycle is still unfolding exactly as they anticipate, and they still perceive a top of this current cycle around the end of 2026 or start of 2027. And they believe that there is a chance that some markets around Australia could see an increase of somewhere between 50 to 70% over the next 4 to 5 years leading up to the top of the cycle. And everything that I'm seeing on a weekly basis from these guys is indicating exactly that as well.
You know, one thing that's important at the moment with those guys is just, you know, subscribe to their weekly email or monthly email at Property Share Market Economics. That's free, like absolutely gold. And if you ever get a chance to see Phil, you know, like the craziest information, like 250 years of data helping you make better decisions today. But those guys sort of got me like more closely looking at the Reserve Bank stuff recently, because like they are having meetings and they're talking about what they're going to do 18 months, 12 months, 6 months from today. So they're the policymakers, and what they've clearly said, which isn't in the mainstream media yet, but we've talked about in previous market updates, is we're just trying to get inflation under control globally. Like globally, the economy may or may not be ready for interest rates to go up as quickly as they are. In fact, many developed countries don't think they are. They're doing it to curb inflation. And as soon as they've got that inflation under control, they want to pull them back. Now, when I looked at Ryan from On Properties data, some of the guys, Simon Priestley's data, and some of the CBA data, there is almost no correlation over 50 years between interest rates rising and property prices declining. But because we haven't seen interest rates increase for 10 years and there's a lot of fear at the same time and there's a lot of uncertainty, people are just freaking, and that's why we're seeing a market decline, which is great. Like a 10 to 15% decline in Sydney, Melbourne is what we want right now. As brutal as that is for someone that bought in March this year at the top, it is necessary for that market to feel good again, and for that confidence to go into the rest of the market after that.
And if you hold the property for the next 30 years, things could look really, really good for you, regardless if you bought in March or not.
You know, exactly. Like we're talking 450%. Even if it does half or a third of that in the next 30 years, people are going to be extremely well off from property in Australia. But what the Reserve Bank is saying is once this is under control, their intention is to pull it down. And while there's no like really, really solid statistical data to go with rate increases, declines, there is really, really strong data from CBA and from Simon Priestley when they look at 30 to 50 years of rates coming down with property prices spiking. And some of the economists that we've been following are suggesting that if rates come down 1%, there's a positive correlation in the years after that of about a 15% jump in prices. If rates get to 5 or 6% retail, then come back to 3.5 to 4 in the next 3 or 4 years, according to some of these economists, we could see as much as 30% growth in the coming years. Some of these analysts that we follow, like Simon Priestley, are actually saying 100% in some markets in the next 5 years. Now, we've got no idea, but it is just, it's crazy. Like CBA at the start of COVID said 30 to 40% drop in prices. Prices went the other way. Like even the Reserve Bank has, you know what I mean? Like none of us, we're all just people taking our best guess and tweaking generally too late.
Yeah.
And so it's like, I'm super excited if you're an investor in this period, like from now until the bottom of the trough, because even when we get to the bottom, it takes the average person about a year later to come back around.
Yeah.
But we've noticed in our business, like a lot of people looking, a very small number of people looking, and now a lot of people looking and buying again. And it's like, it feels like to me that I can buy in Sydney, Melbourne or Brisbane for 15% below in some suburbs right now what you could have paid 6 months ago.
Yeah.
In other suburbs, they're 5% up.
Yeah.
But the discount is now. And when you come in a year's time, when the statistics of CoreLogic get to the minus 15% in Sydney and Melbourne,
you missed the boat.
It's gone.
Well, you haven't
Like
missed the boat, but
it's already passed by the time it arrives in the data.
The data's delayed by sort of 3 to 6 months, and we've felt that back in 2020, back in 2017, 18, and right now as well. Like we can, like good negotiators can price in the discount that they're going to experience anyway, and because like, you know, there's some positive stuff and a light at the end of the tunnel that we're seeing here, it will take time for the data to show up and tell you what is truly happening. And generally, what is happening in the data today is sort of happening in the market 3 to 6 months earlier.
You know, the market, like last time Simon and I caught up for dinner with Phil, which wasn't that long ago this year, he said if it's in the media, it's in the price with the stock market.
Yeah.
And the more I'm starting to learn about the property market, the more I'm seeing it. Like people are saying 15%. All 4 of the major banks are saying that for Sydney and Melbourne. And I'm seeing it in the prices that we're getting today. So if the market is constantly forecasting itself 3, 6, 9 months into the future, just know that. And just the reason I'm saying that is just don't expect a crazy runaway bargain.
No.
I keep hearing these people, I'm going to wait 3 years for a discount. And I'm like,
When does that ever
fuck,
happen?
man. Like, the discount in the last 4 dips was in the first 9 months of the news, not 2 years after it washed through.
No. People like buying property. People want to buy property. They want to upgrade their home. They want to renovate their home. They want to buy investment properties. It's like a birthright here in Australia. And, you know, people have been quite fearful, and their confidence is already coming back into the market in some areas. So you just got to be cautious and look at a number of different commentators, a number of different analysts, look at the numbers from a number of different people as well to try and, you know, get an overarching idea and formulate your own opinion, and then go talk to your mortgage broker, go talk to your accountant, go talk to your financial advisor and figure out if it's within your means or within your current financial situation to be looking at doing something, because in certain markets around Australia, the ceiling is, you know, a lot more positive than the trough at the moment.
You know, one thing, just because I always want you guys to be aware, like now that the, you know, for example, in the last couple of weeks or last week, like the first grain boat got out of the Ukraine, which is the first time, because there's been this global grain shortage because Ukraine ships a lot of that. They've got all of this grain, like 20 million tons or something like that, sitting in silos, or I don't know, I probably have that number wrong, but the first boat left and Russia let it leave. And that is a sign to me that, like, that conflict is super, super, super severe and horrible. But if trade is expected to resume, and all of the, like, future traders in the grain markets have actually put the price back to pre-COVID levels again now in their future markets. And so the expectation is things are starting to fix themselves with global supply issues. And so now we can't talk about, like, the global supply issues because everyone knows about them, and we can't talk about interest rates because everybody knows about them. And the war in Ukraine and Russia is really horrible, but everyone now understands it's over oil, gas and territory more than anything else. Those things start losing traction in the media. So the next thing that you're going to start hearing over the next 3 to 6 months that's going to fucking scare the shit out of people is a Chinese property crash. Now, this is coming through. The question that I asked Phil and Akil this morning, Akil's at Oxford University, is a professor of economics, and Phil's one of the smartest people to ever been born. In my opinion, like, in 200 years, people look back and go, fuck, this guy forecast this. Like, how did he do it? But I've sent them the question this morning, which I'll get back to you in a future update when they get back to me. I want to know how much of the Chinese market, real estate market, is based on international credit. Because if the Chinese market has been funded by Chinese dollars, then it represents a Chinese issue like the Japanese issue 30 years ago.
Which is what they were saying in that update as well.
If the Chinese market has been secretly financed by American, European and Australian banks, which is what I want to know, like the Big Short, I don't know, it's just something that I want to know, then I'll be watching things a little bit more closely personally. But if that issue is isolated to there, then, you know, and all of the future markets are like that's the way that they're pricing it. But sometimes this cat doesn't come out of the bag until things start going bad. You know what I mean?
Yeah, for sure. And you like with China, the information that you get from them as well, you just never know. You never know, like, how accurate.
How
the
big was
information
JP
is.
Morgan in China in the last 10 years? How big was Swiss Bank? How big was Deutsche Bank? Like, these are questions that are important, and it'll come out in the wash anyway, and we'll find out who's been financing what over there and what companies have been winning deals. But, you know, this is the next wave of the cycle. It's completely designed to scare the shit out of you.
Yep.
According to my update this morning from Phil, we are still absolutely on track. Land markets are going to be temporarily affected by sentiment.
Yep.
But the bumpiness that we're seeing in the markets have to do with global supply chains. The tech stocks being completely overpriced for the last 10 years because you've got incredible people like Bill Gates, Elon Musk, like the Google boys, the Facebook guys, all doing this incredible stuff at the same time, and they just drew the whole world in, and everyone wanted to put $1 in that until crypto came along, and then we went that way. But, Yeah, these things are just interesting to me. I like giving you guys these updates so it's not a surprise when it comes up next.
For sure. Like, it's a very turbulent time, there's no doubt about it, but with where we are at in the global cycle at the moment,
Turbulence increases in second half, right?
Exactly. Turbulence is going to increase. And, I think another really cool thing in some of those updates was just the amount of land buying some of the biggest businesses in the world are doing at the moment. Like, outside of China, when you're looking at the biggest businesses that run the world, the Googles, the Amazons, the Microsofts, these guys are currently going on an absolute spending spree and buying so much real estate at the moment as well, which, they're some of the smartest business people in the world. They're not going to be making decisions thinking that their properties are going to crash as soon as they're going to buy them as well. So that means that they have a lot of confidence that the cycle is going to continue moving forward, and now an even bigger incentive to keep the property markets moving forward as well.
There's two last things that Simon and I are aware of that Phil's sort of been helping us get educated on. What we'll start to see now, particularly with rising interest rates, and we've just seen it in the UK, is as they're rising interest rates over there, they're actually making it easier to borrow money.
Yeah.
And we'll start to see that in Australia within the next 6 to 12 months. So the next stage of the cycle is what they call easy credit. And that's because so many people have an LVR in Australia below 50% because they've held properties for the last 5, 10, 30 years. And now that we've just gone through this little boom in Sydney and Melbourne, the bank's balance sheets look a lot better and they are gagging at the bits to write way more credit out than they currently have. But the Australian government is like, and the media is like, no, not yet. But as soon as we get this inflation under control, they are going to loosen the reins and they're going to write as much as they can. And that is going to result in a huge amount of speculation in real estate. The last time this happened, you could get 2% loans, no mortgage insurance, no LMI fees. Like, in some instances, they were giving 20 to 50 grand incentive. So that's one thing. The second thing that Phil reckons that's already starting to happen is Apple, Amazon, Google, Microsoft will see how profitable land and finance are in the next 3 to 4 years, and they'll start writing finance. Now, a lot of these companies have already just started writing personal finance. Once they get the personal finance market for cars, credit cards, or even their own products as their own bank, because they're going, fuck, we've got $200 million or $1 billion cash in the bank at Apple. Why are we letting JP Morgan write our money and make 13% on a phone when we could be our own bank and write the credit? They will move into mortgages for homes and real estate at some point. And I'd be shocked, like, if Tesla doesn't end up becoming a bank, if Amazon doesn't become a bank, if Apple doesn't end up being a bank of some kind, whether it's Apple or whether it's Apple-owned.
With another company.
100%. Like, Warren Buffett owns many of the world's banks.
Yeah.
He owns many of the world's insurance companies, but you wouldn't know it because it's not Warren.
Yeah.
It's Allianz Insurance.
Exactly.
It's JP Morgan Chase. And so this is exciting. I don't know. I just love this shit, eh? I could talk about it all day.
I know, man.
Sorry, guys.
But I think we've gone into some depth here as well.
Yeah.
And it's important to, just know that there's some different things happening around the world, good, bad, indifferent. But this is just the reality of property investing. And as I said, it's always about just, looking at your current financial situation and figuring out if it's within scope to do something, talking with your advisors, talking with the necessary people there, and then taking safe action if you can. But look, the reality is we have no idea what's going to happen short term, but long term, very excited about the future. So we'll see how it all unfolds. But thanks so much for tuning in today, guys. Thanks so much for listening.
Whew,
That's a wrap.
that's a wrap.
Getting
Have
cool,
a spin.
bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that.
So nice, eh?
Oh.